We welcome Peter. And if you saw in the LinkedIn post or anything about the event, he has a lot to share. And I don't know how much we're going to get through today, Peter, but we're excited to have you present and thanks for coming on. We'll turn it over to you. You're muted, Peter. There we
Okay.
go.
Number one, thank you for the invitation. I see people that I know and people whom I don't know, who I suspect are from the Salt Lake area. Um, for you in the Salt Lake area, keep an eye out. My son is working down in southeastern Utah, near Huntington, and if you see him heading your way, just run. It'll be easier for you. Um, so I am going to be talking. I titled the deck "Tax Wins for Founders and Employees," which is dull and boring and dry. Trust me, that's not the way I do presentations. Uh, and I'm covering something that people talk about but don't necessarily pay enough attention to at the right times, and they often make decisions not keeping it in mind, and they end up costing themselves and other people a lot of money, because one of the reasons we start businesses is to make money and ideally to keep it. So, why don't I share the screen or come onto the screen? I assume I should initiate the share,
Yeah, go for it.
correct? Okay. And okay, can you guys see my screen?
Yep.
Okay, and does it have all the junk along the side? And if it does, I sure could use any advice on how to get rid of it. Or I can just go right ahead. I'll just
Just
go right
go.
ahead.
Just go
All
for
right.
it. Yep.
Okay. So, let's begin with who am I? I've got 45 years in finance, 30 years as an early stage or growth company CFO. I've done some turnaround work. I've done close down work. Over the last 30 years, I've had well over 100 CFO assignments. Unusually for early stage CFOs, I'm also a very active investor. I have 60 plus open early stage investments right now. When I figured that out a couple days ago, my head started hurting. I'm invested in 12 VC or VC-ish funds. I'm in 8 angel funds. I am the managing member of 3 of them. I manage 4 SPVs. We're in real estate and debt funds, et cetera, et cetera, et cetera. Um, when people ask me what is my focus as an investor, it's making money for my family. I'm responsible for the family finances, and that includes a family trust that goes 21 years after my sister and I are gone, which is a very interesting metaphysical concept that maybe is worth discussing in a different situation. But the idea of doing financial planning for 2 decades plus beyond my existence is something I struggle with sometimes. Also, who am I? This is a picture of my family's business from sometime in the 1920s. My great-grandfather came here from Hungary in 1920. He was in his mid to late 40s. He had a wife, he had a 12-year-old son, and he came here. I don't think he spoke a word of English. Uh, Through a series of accidents, he ended up as a peddler carrying 50-kilo sacks of Hungarian paprika around Hungarian neighborhoods from Cincinnati to Portland, Maine. And when he put together enough money, he eventually opened up a business. Um, and when I talk about who I am and a lot of my attitudes, it comes from having grown up in this business, having started working there when I was 8, and basically developing a mindset. I've never worked for a business where I don't think of myself as an owner, as a principal, and that affects everything that I see. The thing that is a little bit weird, given what my profession has been, is I was new at the end of the day at Paprikash Weiss how many pounds of paprika we sold, how many salamis, how many noodle makers, how many this is and that's is. And of course, doing finance and especially in the technology business with software, you never have any physical sense of what you have actually moved or sold or anything else. But this is where I come from. Moving along. Why do we start businesses? Okay, some people say they start them to make the world better. If that's your principal reason for starting a business, my attitude is you're doing the wrong thing. You should start a charity. Uh, Businesses certainly can, and I hope often are about making the world better. But the reason it's structured as business is to make money and to increase wealth for the owners. Lots of other things in there. We can get into big, long conversations. But if by winning we make money, we say that's good, keeping more of the prize is a better thing to do. And we're going to spend some time today talking about something that most of you probably know about, but it's worth reminding because as I see the practice of starting companies these days, it really has shifted away and is missing some gigantic opportunities. And I think because people don't necessarily keep all of this in mind. So we're going to talk about Section 1202, and this is why is keeping more of the prize better? Because if your investment in an early stage company, whether as a founder or as a funder, qualifies for Section 1202, you pay little to no capital gains tax on the sale of your shares. That's at the federal level. Varies state by state. Some states don't accept 1202, California, but a lot of states follow the federal tax code. What does this mean? In a big hit, depending on your state tax rate, you can save up to half of your profit. So if I have a choice between doing something and keeping $100 or not bothering to pay attention to some details and keeping $50, I'm usually willing to at least consider doing the things that we have to do. So, what does that get us into? Let's begin with 1202 is usually thought of as an investor benefit. Now, Spencer told me that a lot of the people on this group are founders or would-be founders. Some investors are aware of 1202. I have never had a conversation with a startup founder who is thinking about how to use 1202 for themselves. What is weird is they are potentially the biggest winners. And by the way, so normally it's presented as an investor benefit. It is even more important if you are a founder or a very early employee in the company. What do you have to do to fall under Section 1202? Number one, you must own equity shares. And we're going to come back to that in a little while in two different ways. The shares must be in a U.S. domiciled C corporation. So no S corps. We'll come back to that. At the time the investment is made, immediately before and immediately after, the gross assets of the company need to be less than $75 million. That is a change from the situation at the beginning of the summer, but in the tax bill that passed this summer, the threshold was increased from 50 million to 75 million. Personally, I think that's a benefit to maybe 200 people who are well connected in Silicon Valley because very few of us ever see startups that are going to have more than $75 million or even $50 million when we invest in them. The company cannot redeem a substantial amount of its shares for 1 year before and after the date of the investment. That term is not defined in the law. Most of the attorneys that I know say 2%. Recently, I'm starting to hear a lot of the big Silicon Valley firms talk about 5%. Uh, I always caution every management team to be very careful about that because there, as far as I know, there is no law on that. And so I would be more careful rather than less careful because you don't want to accidentally blow something that can be huge to you. So, having made your stew, equity shares, US C Corp, less than 75 million in gross assets, and no substantial redemption for before or after 1 year from the date of investment, set on the stove on low to simmer for 3 to 5 years, and whoops, where do we get to? We get back to little or no federal cap gain tax on shares. At 3 years, 50% of your cap gains are forgiven. At 4 years, this is going forward, not before the summer. At 4 years, 75, and at 5 years, zero. That's a big win. I live in Washington. We have a state capital gains tax. And if you are in the top bracket, this will save you about 31% of your profit that you get to keep. So, well worth looking at. What are the things you can't do? Number one, no S corps. I always tell people starting companies, if you intend to take in partners or investors, never use an S corp anyway. They go away with all kinds of things that you don't control, and it can really blow up in your face. No partnerships, no LLCs. I will come back to that, and no foreign entities. Now, a company that has a foreign owner can qualify for Section 1202, but it can't be a foreign company taking investment. So far, so good. Pretty simple. And again, let's remember why we're doing this. We're avoiding, not avoiding, we are not subject to capital gains tax if we hit all the tests. So now we get into some philosophy. I've been doing this for 30 years. I have concluded that I do better, and almost everyone does better, when we share and share alike. And we usually win bigger by sharing. Number one, starting a business is a team exercise. Number two, making money is not a zero-sum game. If I add competent people to my team, yeah, I got to pay them. I got to share something with them. But if I'm doing my job right in hiring them, they're going to make us more money than they cost us. Therefore, these are additive. So as we set things up, we should be sharing. That includes employees. It also includes investors. But let's go to the very beginning and let's talk about some mistakes that get in the way of accomplishing this. So we have what I call the LLC mistake. Never used to see this until about 15 years ago. And now I see a huge number of young companies being started as limited liability companies. And when I ask the founders, why are you an LLC? The answer is, well, my lawyer suggested it, which personally I think is one of the worst answers I've ever heard. And it's amazing how often I hear it. So, well, did they explain why? And when the answer is no, I start looking for the door because these are people who can be scary for my family's money. But sometimes the answer is, well, I get to save money on my taxes. To which my next question is, are you personally extremely wealthy? Because if, as a founder, you do not have a very substantial income coming from something other than this business, you probably have no benefit from the tax losses that startups incur being allocated to you. And that's a problem because you may never be able to use those losses. So those losses get wasted. I prefer to see all of the companies that I'm involved in, with very rare exceptions. A real estate company, it's a different story. But companies should be started as C Corps. Why? Because you don't start a business without assuming that you are going to be profitable in the future. If you're not assuming that, why are you starting a business? Start something else. But if you're going to be profitable in the future, you're going to pay taxes. And those losses that you incur in the early years can be applied to your profits as you become profitable. And you don't write a check for taxes. Technically not 100% true, but you massively reduce your taxes. If you have those losses available for the business, you save cash. If you don't have those losses, you start paying more federal tax sooner, and that means you're wiping out your working capital. And you are going to have to raise additional capital at some time in the future. Maybe you're thinking, well, I will give up less of my company in the future. Well, great. But what if it's a tough time to raise money? Personally, I always suggest leaving it there. Starting as an LLC is a mistake. The other reason not to do it is because you delay or may even lose the opportunity to use qualified small business stock because everyone says, oh, when we're ready to make money or take investors or whatever, we will convert our LLC into a C Corp. But you have lost time as a founder that could be qualifying you for that tax exclusion. And so if you start your company and you sell it in 7 years, but you start it as an LLC and you don't convert it until it's 4 years old, your best situation is going to be a 50% tax exclusion instead of 100%. That's silly because whatever tax savings you have will be dwarfed by a successful exit. So, backwards thinking in most cases when people are starting their companies as LLCs for tax reasons. Um, and I frankly can't think of any other reason for starting as an LLC, unless you believe it's going to be a cash flow machine, but that's a very special case. Um, let's also go back to the beginning. So, other things. Remember what I said about share and share alike. In the beginning, pick the right form, should be a corp if you're going to bring in partners, if you're going to bring in investors. But also, in the beginning, you can give, or when you're setting up your founding team or your very early stage employees, and you're putting them into an option plan or a restricted stock plan, you can combine another provision of the tax code called 83B with qualified small business stock, section 1202, and really take good care of your team members. 83B says that someone is buying their shares, exercising their option, or just paying for them up front within 30, within 30 days of grant. So, and it can be subject to vesting, so subject to risk of forfeiture. But if so, it's treated as if they own those shares from the day they make that election. Two things. One, long-term cap gain clock starts running. 12 months later, instead of paying 40% short-term capital gains federal tax, you pay 20. Second, you start your 83, your 1202 qualified small business clock running. This means, particularly at the very beginning, your core team, when the shares are generally assigned virtually no value, this is the opportunity for the people who are going to have the biggest impact on your company to get a huge win. Let's say you get to a nine-figure exit, you sell for north of $100 million, and you've got guys in there, guys, girls, whatever, chihuahuas, who've contributed. You gave them enough shares, and on that exit, their shares are worth $3.5 million. If they had shares very early and held them long enough that qualified small business treatment kicked in, they walk away with $3.5 million. If not, they're going to give up, best case, 20% plus, whatever your state is, but they're going to give up something, figure plus or minus $1 million. So this is a nerdy CFO thing, but I do it for people. By the way, when I do it, when I'm putting a team together and I'm working with my CEO, I make sure that every member of my team knows that we're doing this for them and knows what the potential impact is, because very, very, very few people ever go out of their way to do such nice thing for their team members or their employees, and almost nobody explains it to their team. But when you explain to people that you have just a little bit of work, help them fill out these forms, you get loyalty and you get commitment and you get a sense of being part of this team that comes very, very rarely at, people normally join because of enthusiasm, but I'm doing something that I hope is to buy a very, very nice house at some point, or it's going to put your kids through college, or it's going to be the core of your retirement. And I'm doing this upfront. You would never even have known about this. We've done this for you. There's no guarantee that it's going to work. You got to have a successful company, but it's huge. Um, Timing matters though, because if you wait until your company is worth $20 million when you do a valuation, then they may not be able to exercise their shares. Um, but this is well worth looking at. Um, Investors matter. Um, I know that there are many founders who believe in their heart of hearts that it is an act of virtually inconceivable generosity that you will deign to allow an investor to put some of their hard-earned money to work in your new company. Um, and that they should count themselves lucky and prostrate themselves before you, um, you know, in appreciation. The fact is, you need investors more than they need you. You need investors to fund the business unless you want to write the checks, or unless you're really good at generating revenue early on, in which case, please do. Um, Investors matter, treat them well. And this brings me to another one of my favorite subjects, and some of the folks from Seattle who are on this call have heard me rant at length about this. Safes and convertible notes. Oh my God. They are now 70, 80, 85% of the way of the structure of fundraisings. They're nobody's friend. First of all, they don't start your investors' qualified small business clock running. I have had some attorneys from some fairly large firms tell me I'm wrong, safes qualify. Pretty much everyone agrees convertible notes don't. I've read the Internal Revenue Code. I read it periodically on this thing because I get into these arguments with attorneys all the time. I can tell you categorically the Section 1202 says equity, it says shares, it says stock, it says nothing about simple agreements for future equity. If it's future equity, I don't know how your clock can start running when you invest in a safe. As an investor, I dislike safes anyway. That's a whole nother topic for a whole nother conversation. Um, but you're not doing anyone any good until the safes convert to equity. You're not starting their clock. By the way, one of the angel funds that I'm a part of, has a very substantial investment in a company that we believe is going to get to a very nice exit in 2027 or 28. But because some of the investments were in the form of convertible notes and they only converted recently, there's a high probability that that company will get sold before we qualify for Section 1202 treatment. Am I going to turn down the profits on that deal? Heck no. But am I going to just kind of quietly grumble that if I had been given the opportunity to invest directly into preferred stock, I would have saved 20% plus on that transaction? Yes, I'm going to quietly grumble. Um, so that's my pitch about thinking about investors. Um, it again, these things are important. Um, Now, let's talk about something else that you can use. You're a founder, you're looking to raise capital. Very few investors ever think about qualified small business stock. They hear talks about it, they get very excited. It is never part of their process when they're thinking about investing. Remind them about it. It is not something that differentiates you from other startups, but you know what it does? It differentiates you from other investment classes. Early stage investing is not necessarily that good overall than, let's say, real estate until you get to qualified small business stock. If I invest $100 in a piece of real estate and another $100 in a startup, and 5 years later I sell each of those assets for $400, $300 profit. If I've got a real estate investment and I'm a Washington investor, actually, no, Washington doesn't tax cap gains on real estate. So we'll just deal with federal. If I'm a Washington investor, I'll have a 20 to 24% cap gains hit. So of my $300 profit, I will pay out something on the order of $60 to $70. I get to keep, call it $230, $240. If I have invested in a startup, I get to keep all of it. I get to keep all of my 300. So let me ask you a question. Which is better, keeping 300 or keeping 235? Thank God I got a degree from a fancy business school. Give me a couple of days, I'll come back to you with an answer on that one. But again, when we're pitching, particularly if you're raising a priced round, an equity round, this is worth mentioning to people because, again, they don't have to invest in early stage. They can invest in real estate, they can invest in T-bills. This is a win. All things being equal, this is materially better. So it's worth doing. Remember, you slow things down if you're using a safer convertible, but it is a big impact on your investors, and nobody raising money talks about it. It helps when you're raising money. Um, Keep it in mind for your teams, especially early on. There is always a question of whether you should encourage your team members to exercise their stock options early. As a CFO, I rarely do unless I know that someone has plenty of money, because the truth is it can take many, many years for us to come back to cash, and our companies fail. So we all think about great profits. Team members are often the ones who most want to exercise. I have often, particularly when dealing with someone who is young and has very little cash in the bank, or someone who has a family and a mortgage and three dogs to support, you know, unless it's a very small amount, keep your money in your pocket, because I can't guarantee this is going to come out and it's going to take a while for it to come back. But it's always worth thinking about, and having that conversation. Um, Other than that, thank you. Happy to answer questions. Um, I've covered over a lot of stuff and have not gone, I can nerd out on this for hours, but tried to keep it eye level. So I'm going to
Thanks,
stop the
Peter.
share, and we can have any conversation you want.
Yep, there were a couple of questions that came in while you were chatting, or sharing, excuse me. So let's look at Mike has a question about, he's already got an LLC, need to consider, what to do.
So if you already have an LLC, obviously you're riding that horse. Now, if at some point you think you were going to convert to a C Corp, then it's worth looking at it. And my very broad advice is the sooner you do it, the better, because changing entities is a pain. Speaking as a CFO, I can show you all of my scars and my still bleeding wounds from having done LLC to corp conversions. And it's a lot more than just these tax implications. Um, it can be very tricky to convert from an LLC to a corp, because if you have a negative net worth, which is often the case in a young company, um, to the extent that you just wipe out that negative net worth, the owners get what is called attributed income. That's a conversation for another session, but I will send down a copy of my deck. It has my contact information on the last slide. Very happy to have that conversation. But if you already have an LLC, don't just announce one day, I'm going to flip it without having done some planning. And I'd be very happy to walk you through that and let you know where there are
Would it
landmines.
would it would it be possible to or advisable to create a new C Corp and then assign or sell the assets from the LLC to the new C Corp and then keep both companies?
Um, Possibly, well, the answer is, as you asked the question, yes, it is certainly possible. Whether or not it's the way that works out best for you is situational. And again, that kind of brings us down into the weeds. And feel free to reach out and we can have a conversation. I'll give anybody an hour and no expectation.
Very
Josh had a
cool.
question
You,
about location. Is it certain states that make this easier or harder? You mentioned California has some intricacies.
Okay. So, um, as a very general rule of thumb, one, if you don't have to have nexus and connection to California, you shouldn't. As a second very broad general rule of thumb, it's really hard to apply rule number one because California is 20 or 25% of our national economy. It's 20% of our population. It's where an enormous amount of talent is. Um, it's just hard to avoid California. Um, and it should be done thoughtfully. But, you know, where you pay taxes is a result of how you live your life. Um, QSBS is an owner's issue, not a company's issue. Um, so if I invest in a California company, but I'm a Washington resident, California doesn't tax me on the gain on that sale. I don't believe, although there may be someone on here who knows more than I do. Um, but generally, it's going to be where I'm a resident. Uh, some states follow the feds. Just, you send them your 1099 and they tax you accordingly. Some states don't. Some states do a mix. Um, the taxability of your investor, the tax locations of your investors is not your problem as a founder. And now, if we're doing an LLC, again, this is a side issue, I write my distribution provision noting that there can be people in very high tax locations. But again, that's for another time, and it's a nuance.
Other questions? We've got time for one or two more. Peter, from you're an active investor. If you I mean, do you like it when a founder has a half a slide in their deck that says, "Let me show you or tell you about the my QSBS plan here"?
Uh, I love the awareness when it says we are Section 1202 qualified small business stock eligible. And one of the things that I put into all of the term sheets that I write for my clients or I request if I'm negotiating on behalf of investors is a request for reasonable business efforts to maintain qualified small business stock status. I also recognize that something might happen that blows it up. And so I would never put it in as a requirement that a company not do something because if for good business reasons, that's ultimately going to increase our wealth, they should blow it. They should. I have yet to see one of those, but I don't believe that is necessarily impossible. So, as an investor, I want to encourage my companies to do things that will be good for them and good for me and good for my family, but I also never want to tie their hands in a way that might get in their way of them doing that. It is interesting. What I see on a lot of term sheets is the company's eligible for Section 1244. Section 1244 is the flip side of 1202. 1244 is the one that lets the investors who provided the first $1 million of investment take ordinary losses if the company goes under. Uh, it's nice to know they're worrying about me. And by the way, I've been CFO of companies that we've had to close, and I send letters to my investors who can get 1244 treatment saying, by the way, we're really sorry we failed, but here you go. I call this the Miracle Max school of being a CFO. The difference between almost dead and all dead. If they're all dead, all you can do is go through their pockets and look for loose change. That's the looking for loose change. Okay, I can get you a better write-off on your loss if you're in my first $1 million of investment. Um,
Okay.
nice to know that they're looking out for the downside, but I'm looking for the upside.
Yeah.
And so good to know. like it. And again, now, by the way, it does get in the way if you're telling people that you're going to exit in 18 months because they won't qualify. Um, I can count on the fingers of one finger the number of companies who told me that they were going to exit that fast and actually pulled it off. Um, and actually, some of the people on this call were in that deal through one of our angel funds. Uh, but that was a convertible debt deal, and they told us, we can double your money in 4 months. And we said, well, if you can, great. Otherwise, we're okay owning your shares. And they got the company sold in 4 months, and we got a little over 2x. And so we paid some tax. You know, on an IRR basis, 4 months, more than double your money, less a little tax. This is pretty good. I know most of you do better than that in your checking accounts. I don't.
Peter, a couple of questions, and I think you hit on Jim's here in the about writing off the losses. It's the first million, is what you shared. Chris asked about the changes, if that's this year or next year, or what's the start date as a new
Any,
holding?
all right, so any investment made after the date, I believe it was the date that the bill passed, but it may have been the date the president signed. Either way, it was sometime, I believe, in July. Any investment made from that date on qualifies for the faster threshold and the higher threshold. Doesn't in any way undermine the earlier rules. Um, by the way, let's talk about what are the limits of the benefit here. It's 10 times your investment, or it was $10 million, now it's $15 million. This is why it's so important for your founding team. Your investors, if they're angels, are typically going to put in 25 to $200,000. They do 10 times $200,000, that's 2 million, that's very nice. But your founding team may own a lot more stock than any individual investors do, and you as a founder almost undoubtedly will. And you might have a shot at walking away with 10, $15 million or even more. Well, saving the tax, I mean, let's say that you just had a $10 million hit. Essentially, you've got a zero basis in it. So your gain is $10 million. By the way, you will be in the Medicare surcharge tax rate, so you'll pay an extra 3.8%. 23.8% of $10 million is $2,380,000. Okay. Now, you would still keep 7.2 million. Not a terrible outcome. But if your choice is keeping 7.2 million or keeping 10 million, which would you rather do? So again, when I look at people who start as LLCs because they're getting the write-offs up front, and I look at them and say, how well do you think this business is going to do? Oh, I think it's going to be huge. I think we're going to get to a, $500 million exit. I look at them and go, well, then why are you doing this? Uh, and again, if you've got people who come in really early and can buy their shares for next to nothing, or they get them because they're there as part of the founding team, this can be huge. This can be life-changing for them. And keeping that extra amount really makes a difference for them. And to me, it's very important that we share those opportunities.
Okay, last question, and then we'll wrap. From Vin, any suggestions as to how to handle a repurchase or redemption from a departing founder so as to not trigger a disqualifying redemption transaction?
Couple of ways. Uh, had the situation in two of the companies that I've invested in, and what we ended up working out with the company was allowing the investors to pro rata purchase those shares. Now, those shares at that point do not qualify for 1202 because another criteria is original issue. I've left that off my list. I'll fix that before I send this out. Um, but that way we avoid the redemption problem. Now, it's only a redemption problem for people who are investing within 1 year plus or minus of that redemption. But we've had investors buy it up, just send out a note. Hi, everyone, we have this many shares coming in. It'll cost this much per share. let us know how much you want, or we just announce, here's your pro rata and let us know if you want more if it's not all taken. And that has worked well. Everyone feels really good about that. Um, I have been told that there is some kind of exemption for redemption in departing founders. I've read 1202. I didn't see it in there. I don't know if there's a court ruling or a tax letter that says that that's okay. I've been told it. I don't know the truth. I don't know if that's right or not. And by the way, that's the kind of thing, folks, feel free to always send me a note. Remind me where I ran into you, but feel free because, I'm enough of a nerd. I actually like digging into this kind of stuff, which says there's all kinds of issues with my personality, but we'll leave that aside.
Peter, we're grateful that you could come and spend some time with us in this group. Thank you. You all are welcome to join us any Tuesday at 11 a.m. Mountain Time. And you can see us on LinkedIn for the upcoming speakers. And we'll leave it there. Thank you.
Thanks, folks.
Thank you.
Thank you, Peter.
Thank you very much.
Thank you.
Thank you.
Good presentation.